IMF, From Creation to Today, Impact on Developing Countries, 1944 to 1950s, Birth of the IMF, created at the Bretton Woods Conference, 1944, to stabilize currencies and promote global trade. Focused mainly on Europe's post-war recovery. Developing countries in Africa, Asia, and Latin America had little influence in this early stage. 1960s–1970s, expansion into developing countries. As many nations gained independence, they joined the IMF. The IMF provided loans when countries had trade and payment imbalances. But during the 1970s oil shocks, many developing countries borrowed heavily, leading to debt problems. 1980s, the debt crisis and structural adjustment. Many developing countries could not repay debts. The IMF introduced structural adjustment programs, SAPs, requiring cuts in government spending, education, health, subsidies. Privatization of state-owned industries. Market liberalization, opening up trade and finance. Intended to modernize economies, but often deepened poverty. Effect: in countries like Zambia, Ghana, and Somalia, reforms led to job losses, higher prices, and weaker social services. Ordinary citizens, especially the poor, suffered the most. 1990s to 2000s, debt relief and poverty reduction. Widespread criticism pushed the IMF to reform. Launched the Poverty Reduction and Growth Facility, 1999. With the World Bank, created the HIPC initiative to reduce debt in the poorest developing countries. Nations like Mozambique, Tanzania, and Somalia gained debt relief, freeing resources for public investment. 2010s, crisis response in developing countries supported economies during crises. Global financial crisis, 2008–09. Ebola hit countries, 2014–16. Somalia, 2013 onward, IMF re-engaged, guiding economic reforms and debt relief. 2020s, pandemic and recovery. COVID-19, 2020, IMF gave emergency loans and grants to developing countries. Helped them maintain basic health and food systems. Somalia, 2020–23, reached debt relief milestone, reducing billions in debt. Overall impact on developing countries. Positive contributions, prevented financial collapse in crises. Debt relief gave space for investments in education, health, and infrastructure. Provided technical assistance to strengthen institutions like central banks and tax systems. Negative impacts. Loan conditions often required austerity, spending cuts, tax increases, that hurt the poorest. Sometimes prioritized debt repayment over immediate social needs. Developing countries often had less voice in IMF decision-making compared to richer nations. Checkmark in Somalia's case. Excluded from IMF support during decades of conflict, 1991 to 2013. Since rejoining, Somalia has benefited from debt relief and technical assistance. But reforms demanded by the IMF, like reducing subsidies and increasing taxes, can put extra pressure on citizens already facing poverty, conflict, and climate challenges. Right-finger summary. Since 1944, the IMF has shaped the economies of developing countries by offering loans, demanding reforms, and later providing debt relief. Its support has brought both stability and hardship, stabilizing governments and rebuilding economies, but often at the cost of short-term suffering for ordinary people.